Hello. Ksolves Limited has not been doing well in terms of its financials and especially its stock price. Here is its stock price. As you can see, in around January 2025, it was 512 rupees. Then it fell massively. It fell massively to, you can see the current levels, 320, 320, 325. Now, what caused this? This was caused by maybe investors losing a bit of trust because the earnings of the company has not been doing well. Now, look at these earnings. As you can see, for example, March 2024. Okay, these are the quarterly earnings. And let me make myself go here. Look at this. Ju- June 2023. Okay, June 2023. The net profit margin, the NPM, this green line was 31.9%. Okay, March 2024. The net profit margin was 30%. Even December 2024, we see a bit of a stress, 27%. And look at this, March 25. March 25, the NPM, the green line, fell all the way to 17.58%. Massive drop. And look at that, the sales growth has also stopped. And then it is trying to slowly recover, with the latest quarter only delivering 21% of net profit margin and only 13% growth. Only 13% growth. See, these are the quarterly results of the company. Yeah, these are the quarterly results of the company. The percentage below the top line are the growth rates. And you can see since March, 9.49% growth, a nice 19% growth, but followed by 13% of growth. So sales growth has kind of slowed down. Margins have not recovered to their earlier highs. So the question is KSOLs Limited a done company? Is it a company in decline? Is the stock going to go down even further? The answer is I don't know. But let's take a look. Okay, hold up. What happened? Yes. Now, what led to the massive decrease in the EBITDA margins from 30% to all the way to, sorry, the net profit margin, 30% to like 17%, 21%? What happened? This is what happened. So, you see this quarter four fiscal year 2025. They refer to this as the base quarter and see the strategic investments from quarter four fiscal year 2025 onwards created a new base for margins, albeit for future growth. So, for future long term growth, they made investments in quarter four fiscal year 2025, where we saw the massive drop in margins. Let me just go back to there. Where is it? Yeah, here it is. See the massive growth. Quarter four. This is the growth. See quarter four fiscal 2025. Net profit margins fell from 27% all the way to 17%. Operating profit margins, OPM, 57% to 25% still not recovered. So what were these investments that they made, these long-term investments? Now you can see first, ESOP. Okay, first one, ESOP, employee stock ownership plan expenses for employee retention and long-term incentives. So they had to give this is a recurring type of investment. Okay, recurring. This will happen again and again. This is long term. 1.75 percentage point impact was there. So margins fell from let's say 37% to around 35.25% because of this. Then they hired some top level hirings and salary. So they hired some new people in senior positions. Example one of the examples was someone for the Salesforce. Their Salesforce products have been experiencing a lot of competition. So, in order to mitigate that and promote the Salesforce product, they hired someone from Salesforce or related to Salesforce, a Salesforce director of sorts. So, this is a long term expense. This is also recurring. 3.77 percentage points impact on the EBITDA. Okay. Then, finally, very importantly, events participation. So promoters and the company's employees, they were participating in events to promote their products. Very important, promoting the new products like DFM, data flow manager is a new product. Okay, this is also a non-recurring. So this is non-recurring. So from this year onwards, they won't have a lot of this. So this expense will go on decreasing. And this had a massive 5.12 percentage points impact on EBITDA. Focusing on See, it focused on branding and market presence initiative. Okay, so these were the 10.64 percentage points impact on EBITDA margins in quarter one fiscal year 2026. And if we see this, look at this. Quarter one, 17.07%. You see, 17.07% on EBITDA margin was 26% net profit. So if we add 10 to this, 10 percentage points to this becomes 36.93% operating profit and 27% net profit, which is the pre ones. This is almost equal to the pre expenses. Okay, the pre expenses. So, yeah, this is what caused the margins. Now, second was the sales growth. Why has sales growth gotten a bit down? Look into this. We will take a look at this. See the three pillars of a growth strategy. Now, earlier, what they used to do, what KSOL used to do, they will partner with small and medium enterprises for mutual and concurrent growth. These enterprises will grow, KSOLs will also grow. Then they started small with large enterprises. So they will get some small software development work for some large enterprise and then start selling them more and more products. Now, now what they're trying to do, they're trying to execute high impact projects, massive impact projects, meaning a lot of money, high monetary value projects after steady pursuit via request for proposals. Basically, now, what this strategy is the new pillar for growth. See, these two things they still do, but this is the new pillar, the new focus, where they're going to pursue a project for some times. So the sales process, the sales the process for getting a new sale will increase. Time will increase. It will take more and more months because they're steadily pursuing these projects, which will bring a lot of money, will bring a lot of future growth. However, at the expense of current growth. Because again, after steady pursuit, there are going to be some time taken in order to complete these projects. Okay. So with these steady pursuits of high impact project, they're trying to journey to a mature business model. Okay. For example, one way is this moving towards turnkey projects and high value delivery service. Again, high impact projects we saw earlier. Maybe wondering what is turnkey projects. So earlier, KSOLs will get, let's say, a big company has this project they want to work on. KSOLs will get a small part of the project. Now, what KSOLs is trying to do is get turnkey projects. Turnkey means KSOLs will do everything of the project, the designing of the project, final delivery, who are they going to hire, how many people they can hire. Everything will be done by KSOLs themselves. They will complete the entire project. And these are high value service. This will provide a lot of margins, a lot of money. However, for these high impact projects, look at this. These projects are bigger deals, longer clocks. Large projects inflate extended conversion timelines to months and quarters. So these large projects that they have are extending the conversion timelines. Conversion timelines, converting into revenue, converting the work into revenue. Okay, converting to months and quarters. Then bigger deals means longer contracts. So these deals are going to take months and months to actually generate revenue, though they're saying a lot of revenue. And finally, there's going to be some short-term variability expected as part of the maturity process. So in order to become a mature company, in order to get these big projects, do some big work, it's going to take some short-term fluctuations and volatility. So impact on margins, short-term impact on growth. But in the long term, they're saying all of these things, all of these things, okay, trying to mature into a full-fledged business model, hiring all of these new people, making all of these new investments. Okay, ESOPs, top-level hirings, events participation, all these marketing expenses in the long term, it will really benefit KSOLs. And finally, for their future growth, one more thing I need to say is this. Now, you see these key products, okay? Who do Salesforce products? This is the main new thing. DFM, Data Flow Manager. Now, to literally manage data between different systems, it provides a better user interface. From what I don't understand this, but basically, to manage data, big corporations, between different systems because corporations use a lot of systems. So data needs to transfer from one system to another, and they may be different systems, completely different systems. So this DFM product, it makes it easier, way easier, way more cost effective. That's what they claim. And they currently have a few clients in the pipeline. So they are actually almost selling this product. This is the new big thing. To give some insight, they have said that this product will be used by companies which are at least $100 million in size and billion-dollar clients. That's what they're aiming for, and that's what the product is suitable for. And second, other product, Mind AI Ninja. Now, this is important. These products are important. Why? Because they're their own products. Ksolves is trying to develop their own products, trying to get some product-centric growth, not just trying to rely on Salesforce, Odoo, or all these technology partners like they already have, but trying to do something else. That page, the earlier page, Journey to a Mature Business Model. This is this. Look at this. Product centric growth strategy. Significant revenue potential identified in product lines. Product centric, trying to make their own products. So currently they are having DFM, Mind Ninja AI, and earlier, look at this. This was the earlier success. Dashboard Ninja with AI. Dashboard Ninja with AI. This was the number one app on the Odoo store for 4 consecutive years. Highest grossing app on Odoo store. In direct like revenue generated, it has generated like $1 million, 8 crores, and it's generating crores for them. This DFM product. Okay, that's what they're trying to do. Develop their own products. Okay, again, Mind AI Ninja. These are the new things they're trying to do. So this was case solves. Let's see how it, let's see how their investments work out in the future. So as a summary, the company, in order to become a mature company, again, they have stated that their competitors are literally like Infosys, big companies. The work that they're doing is similar to they're claiming that the work that they do is similar to what Infosys, I think LT, and I think Persistent Systems, these companies do. It's similar that they do. So they're trying to become a mature company, transfer into a mature business model, focusing on these new products, their own in-house products, and for longer growth, they had to make some expenses. And finally, for fiscal year 2026, they have an aim to grow around 20%. Yes, revenue growth 20%, and they do not want their EBITDA margins to decline below 30%. So 30% is what they're aiming their EBITDA margins to be, 30%. And currently, how much is it? Hold up. Currently it is 30%. OPM, operating profit margin. Okay, not NPM, net profit margin. OPM is 30%. So they're aiming for 30% operating profit margin and 20% growth in sales. And if you finally want overview of the company in the profit and loss statement, you can see past 5 years, 68% compound sales growth. Past 5 years, 119% compound sales growth. See, TTM or trailing 12 months has not been that solid. See, 18%, still okay, that's nice. 18% nice. Profit growth, 15% only. Now, I need to say this. Return on equity is actually phenomenal. 154% return on equity. I think they have 200% return on capital employed. In these ratios, the company really does not need to use or utilize a lot of assets. That's why returns are so high. They're like more than the asset, the equity base basically. Because return on equity, the denominator is equity. And finally, in 2025, the company generated sales of 137 crores, operating profit of 48 crores, and finally, net profit of 34 crores. So that was it. You see, last year's also was 34 crores. So that was it. That was Ksolves Limited. Let's see if they're successful in the journey towards long-term growth and long-term profits and eventually mature into a big software company. Bye.